Okay, so someone hands you a gold mine tomorrow. Maybe it's a real one, a working operation deep in Nevada, or a shuttered pit in Ontario, or a discovery in Western Australia that a junior company just ran out of money to develop. However it happens, the mine is yours. The gold is in the ground. The price of gold is sitting at around $4,000 per ounce right now, near the highest it has ever been in human history. And you own a piece of land full of the stuff. The honest answer is maybe, possibly, depending on a set of variables so complicated that some of the most experienced mining executives on the planet have gotten them catastrophically wrong. There are gold mines sitting on billions of dollars worth of metal in the ground that have sent their owners into bankruptcy. There are small operations producing a few 100,000 ounces a year that generate more cash than most companies in the country. The difference between those two outcomes is not luck. It is economics. And the economics of a gold mine are almost nothing like what most people imagine. Here is what it actually looks like from the inside. The first thing to understand is what gold in the ground actually is, and what it isn't. It is not money. It is not even close to money. It is a raw material locked inside billions of tons of solid rock, distributed at a concentration so thin that you could spend years trying to find it with your bare hands and never see a flake. Modern gold mines do not find treasure chests. They find ore. Ore is rock that contains metal, in gold's case, usually at concentrations measured in grams per metric ton. Not grams per pound, not grams per kilogram, grams per ton. To get 1 ounce of gold, a coin-sized piece of metal weighing about 31 grams, a typical open-pit gold mine might need to blast apart, haul, crush, and chemically process anywhere from 30 to 300 tons of rock. That number is called the ore grade. It is the single most important number in gold mining, and it is the first thing that determines whether your mine is worth anything at all. A mine with a grade of 1 gram per ton is running on thin margins. A mine at 3 grams per ton is doing reasonably well. A mine at 8 grams per ton is extremely valuable. And a mine at 30 grams per ton is the kind of once-in-a-generation discovery that transforms small companies into billion-dollar businesses overnight. The Fosterville mine in Victoria, Australia, found a zone in 2015 that averaged over 44 grams per ton. That discovery was so extraordinary that it drove the mine's cost of production down below $400 per ounce, at a time when gold was trading well above $1,000. It turned a marginal asset into one of the most profitable gold mines on Earth, but most mines are not Fosterville. Most mines are sitting on 1 or 2 grams per ton, processing millions of tons of rock annually, and doing complex financial math every single day to figure out whether they are making or losing money. That math is the thing nobody tells you about when they hand you the mine. Let us say the mine you have inherited is undeveloped. You know there is gold in the ground because previous owners spent years drilling and testing. There is a report sitting in a filing cabinet somewhere that says the deposit contains 3 million ounces of gold. On paper, at $4,000 per ounce, that is $12 billion worth of metal. Before you touch any of it, you need permits. In the United States, permitting a new gold mine typically takes between 5 and 8 years. Canada runs between 5 and 7 years, though the federal government has recently been pushing to compress that timeline. Australia can move in 3 to 4 years if things go well. These are not edge cases or bureaucratic failures. This is the normal timeline, and it represents a serious financial problem. Because here is what happens during those years. You are not earning revenue, you are spending money, you are hiring environmental consultants, legal teams, engineering firms, and community liaison officers. You are conducting impact studies on water, on wildlife, on land stability. You are negotiating with indigenous communities, local governments, and federal regulators simultaneously. Every month of delay while you are paying staff and contractors and interest on any borrowed capital is money leaving your account with nothing coming back in. And you have not even started looking at what it costs to build the mine itself. Let us rewind further. Before you can even apply for permits on most projects, you need to prove what you have. And proving what you have requires drilling. Exploration drilling is expensive in a way that is genuinely shocking to people outside the industry. A single drill hole might go 1,000 meters into the ground through hard rock at a cost of between $200 and $400 per meter. If you are drilling 100 holes to define your resource properly, you are looking at $30 to $60 million just in drilling costs, before laboratory testing, geological analysis, and engineering studies. The industry as a whole spent $67.5 billion on gold exploration in the decade between 2009 and 2018, according to data compiled by Minex Consulting. The average cost of finding 1 ounce of gold during that period was $62 per ounce. More than double what it cost in the decade before, as shallow deposits grew harder to find and companies were forced to drill deeper. $62 of exploration cost per ounce does not sound like much against a $4,000 gold price. But here is the trap. Not every exploration program finds anything usable. Most of them find nothing at all. You might spend $50 million drilling a promising piece of land and conclude, after 2 years, that there is not enough gold to justify a mine. That $50 million is simply gone. There is no refund. The geological gamble did not pay off. This is why exploration companies fail constantly despite technically finding gold. Finding gold and finding profitable gold are completely different things. Assume the exploration succeeds, the permits are eventually granted, and you have a viable mine. You now need to raise the money to build it. This is where the financial structure of the project becomes just as important as the geology. Very few companies, and almost no individuals, sit on the kind of cash required to build a gold mine from scratch. A billion-dollar project typically gets funded through a combination of bank debt, equity raised from public markets, corporate bonds, and sometimes a specialized instrument called a streaming agreement. In a stream deal, a company like Franco-Nevada or Wheaton Precious Metals provides upfront construction capital in exchange for the right to purchase a fixed percentage of the mine's future gold output at a deeply discounted price, sometimes as low as $400 per ounce. Regardless of what the market price does, these deals can look attractive when you need cash and your project is years from production. But they come with long-term consequences. Every ounce of gold you commit to selling at $400 is an ounce you cannot sell at $4,000. Over a 20-year mine life, the total cost of that early financing can quietly run into the billions. Debt creates similar pressure. A company that borrows $1 billion at 5% annual interest owes $50 million per year before it repays a single dollar of principal. If commissioning is delayed by 12 months, which is common in mining, that is $50 million of interest on money not yet generating any revenue. Many gold mining failures start not with bad geology, but with a balance sheet that cannot survive the inevitable surprises of construction and ramp-up. Let us say your mine is different. The drilling worked. The resource is real, the grade is solid, the permitting is done, and the financing is in place. Now you need to actually build a mine. Large modern gold mines cost hundreds of millions of dollars to construct. Frequently, they cost more than $1 billion. Some of the biggest projects have pushed past $3 billion, $4 billion, even $5 billion before producing their first ounce. Barrick Gold's Gold Rush project in Nevada, a single underground mine at an already existing operation with existing infrastructure around it, carries a capital budget of approximately $1 billion for a mine expected to produce around 400,000 ounces per year. Roads first. If your mine is remote, and most new gold deposits are remote, because the easy-to-reach ones were found a century ago, you need roads capable of carrying mining trucks that weigh several hundred tons when loaded. Those roads are not paved country lanes. They are engineered infrastructure built on rock that needs constant maintenance. Power. A large processing plant might consume as much electricity as a small city. If the grid does not reach your mine, you build your own power generation. Diesel generators, gas turbines, or in some cases dedicated transmission lines extending dozens of miles from the nearest connection point. Water management. Mining generates enormous quantities of contaminated water. You need treatment systems, holding ponds, line tailings facilities. If you are in a dry climate, you also need a water supply. If you are in a wet one, you need flood management, the processing plant itself. This is where the actual gold is extracted from the rock, a sequence of crushers, grinding mills, leaching tanks, and chemical recovery circuits that can cost hundreds of millions of dollars on their own. The grinding mills are particularly expensive. Giant rotating cylinders filled with steel balls that reduce crushed rock to fine powder, consuming somewhere between 40 and 50% of the plant's total electrical power in the process. And then housing. Mechanics, doctors, cafeterias, helicopter pads for fly-in workers. A remote mine is not just a factory. It is a small town that the company has to build, staff, and run. All of this comes before you sell a single ounce of gold. Once the mine is built and producing, the costs do not stop. They become permanent. The most visible ongoing cost is the equipment fleet. A large open-pit mine runs dozens of haul trucks, each capable of carrying between 200 and 400 tons of rock per load. A single ultra-class mining truck, the kind that looks like a 2-story building on wheels, costs between $3.5 million and $5 million. And that is just the purchase price. The tires on those trucks cost between $40,000 and $75,000 each. One truck needs 6 tires. Mining haul roads eat tires alive because of the abrasive rock surface and the constant weight. A typical tire might last only a few months under heavy use. A full set of replacement tires for a single truck costs up to $450,000. Multiply that across a fleet of 60 trucks and you have a tire budget alone that would fund a medium-sized business. It is the kind of number that does not appear in any romantic notion of owning a gold mine, but it appears very clearly on every monthly operating report. Then there is fuel. A large mining truck burns around 30 gallons of diesel per hour. At full operation, running around the clock, one truck can consume nearly 1 million gallons of diesel in a year. When diesel prices rise, as they do whenever oil markets tighten, mining operating costs rise with them, automatically, unavoidably, even as the gold price might be falling. The mine has no ability to renegotiate its fuel costs downward. It either pays the market price or it stops operating. Beyond the equipment, there is the processing plant itself to maintain. The grinding mills that crush ore into fine powder run continuously. The steel balls inside them wear down and must be replaced constantly. The cyanide used to dissolve gold from crushed rock is consumed with every cycle. The activated carbon that captures dissolved gold from the leaching solution must be regenerated or replaced. These are not one-time costs. They are recurring expenses that compound over the entire life of the mine. Every day, regardless of what the gold price is doing, labor is the other enormous ongoing cost. A gold mine at full production employs geologists, mining engineers, metallurgists, blasting specialists, equipment mechanics, safety officers, processing technicians, environmental monitors, and an entire corporate support structure above all of that. Remote mine sites pay significant premiums to attract qualified workers, and they typically fly them in and out on charter aircraft every 2 weeks. Add in accommodation, food, medical services, and training, and the human cost of running a mine becomes one of the largest single line items on the balance sheet. In 2025, United States mining wages rose over 8% year-on-year according to Bureau of Labor Statistics data. When your entire workforce is skilled and specialized, an 8% wage increase across the operation adds tens of millions of dollars to your annual cost base, with no corresponding increase in gold production. The mining industry eventually decided it needed one metric that captured all of this. Every cost, direct and indirect, that it takes to sustainably produce an ounce of gold. They called it the all-in sustaining cost, or AISC, and the World Gold Council introduced it as a standard in 2013. The AISC includes the direct cost of digging, crushing, and processing ore. It includes the sustaining capital needed to replace worn-out equipment and maintain tailings dams. It includes corporate overhead, near-mine exploration to replace depleted reserves, and an accounting provision for the eventual cost of closing the mine and restoring the land. In other words, it includes everything. In 2024, the average AISC for gold production in the United States rose to $1,716 per ounce, according to data from S&P Global. In Canada, it was $1,513 per ounce. These are averages. The most efficient producers in the world, the ones sitting on the highest grade ore with the best infrastructure, can achieve AISC below $1,200 per ounce. The least efficient mines, the ones digging in difficult geology or remote terrain, can push past $1,800. At today's gold price of around $4,000 per ounce, the spread between a good mine and a bad mine looks like this. The best mine in the world might be earning $2,800 of profit on every ounce it sells. A struggling mine with costs near $2,000 per ounce is earning $2,000. Both sound fine at $4,000 gold, but run those numbers back 10 years, when gold was sitting at $1,200 per ounce, and the struggling mine is bankrupt while the good mine is still profitable. That 10-year scenario has happened multiple times to major companies. Here is the trap at the center of every gold mine's economics. Your costs are mostly fixed. The truck payment does not go down when gold falls. The drill contract does not renegotiate itself when prices drop. The wages do not drop because the commodity is having a bad year. The debt repayment schedule certainly does not flex, but your revenue is completely entirely dependent on a number set by global financial markets that you have absolutely no influence over. Gold traded at $250 per ounce in 1999. It hit $1,900 in 2011, then fell back below $1,200 for years. It crossed $3,000 in March 2025 and hit its all-time high of over $5,500 in January 2026. At the time of this video, it is sitting around $4,000. JP Morgan Research currently projects gold could average $6,000 per ounce by the final quarter of 2026, though forecasts like this should be read as directional views rather than guarantees. Every point along that price history, there were mines that were profitable and mines that were not, and they were sometimes the same mine. An operation that looks like a cash machine at $4,000 gold can be a money-losing liability at $1,200 gold. And it cannot simply pause. It has debt to service. It has environmental obligations that continue whether it is producing or not. It has a workforce it cannot simply suspend. Consider what happened to Newmont and Barrick, the two largest gold producers in the world, in early 2026. Despite gold trading near record highs, both companies saw their share prices fall sharply, with Newmont down 26% and Barrick down 19%. The reason was not falling gold prices, it was rising costs. Newmont projected its 2026 all-in sustaining cost to reach $1,680 per ounce, driven by labor shortages and ballooning equipment costs. At that level of cost, even $4,000 gold, the margin looked thinner than investors had expected, and thin margins on leveraged balance sheets make people nervous. This is why experienced mining analysts often say that the moment you build a gold mine, your primary business is no longer mining gold. It is managing the gap between two numbers that move independently, what it costs you to produce and what the market decides to pay. In 2015, a company called Rubicon Minerals had what looked like one of the most exciting gold discoveries in Canada. Their Phoenix deposit in Red Lake, Ontario, had an estimated resource of over 3 million ounces. Serious money in serious numbers. The company built a mill and sank a shaft, spending hundreds of millions of dollars on infrastructure. When they started underground mining, the gold was not where the model said it would be. The deposit was far more geologically complex than their surface drilling had suggested. Their surface drill holes had been oriented in a direction that ran parallel to the actual gold-bearing structures underground, meaning the drilling had systematically overestimated how continuous the gold zones were. When real mining exposed the rock, the gold appeared in narrow, disconnected pockets rather than the broad, mineable zones they had planned around. In January 2016, Rubicon released a revised resource estimate that cut their indicated resources by 88%. Nearly 9 in 10 of the ounces they thought they had owned, on paper, ceased to exist. The company halted operations, laid off 330 workers, and eventually filed for creditor protection. The equity that investors had bought into was essentially wiped out. The gold was real. The mine was built. The company still failed, and Rubicon is not an isolated case. In 2013, Barrick Gold, then the world's largest gold mining company, suspended construction on its Pascua-Lama project straddling the border of Chile and Argentina. The deposit was genuinely massive, 18 million ounces of gold and 731 million ounces of silver. Initial construction cost estimates were $3 billion. By the time the project was suspended, costs had ballooned to over $8 billion, driven by environmental violations, regulatory fines, and a tax dispute between Chile and Argentina over which country deserved what share of the revenue. Barrick took a write-down of $5.1 billion in a single quarter. The biggest gold company in the world, on one of the biggest gold deposits ever found, lost $5 billion. This is the industry. These are not cautionary tales pulled from fringe operators. These are the biggest names in the business, making decisions with full access to engineering expertise, geological data, and financial resources. Here is something almost nobody thinks about when they imagine owning a mine. Every gold mine will eventually run out of gold. Or the grade will drop so low that the economics no longer work. Or the gold price will fall to a level where production becomes impossible. When that happens, you cannot simply lock the gate and walk away. In every modern mining jurisdiction, the obligation to properly close and restore the land is yours, it is legally binding, and it is extraordinarily expensive. Closing a mine involves removing or demolishing surface infrastructure, contouring waste rock dumps so they do not erode or collapse, capping tailings storage facilities with engineered clay and soil covers, and monitoring local groundwater quality for potentially decades afterward. Depending on the chemistry of your waste rock, this monitoring might need to continue indefinitely. The giant mine in Yellowknife, in Canada's Northwest Territories, closed in 1999 after its operator went bankrupt without having set aside adequate closure funds. The site sat contaminated for years, ultimately becoming the responsibility of the federal government. The remediation budget for that single mine reached 4.38 billion Canadian dollars by 2022, a figure driven in large part by 237,000 tons of highly toxic arsenic dust stored in underground chambers, which must be kept permanently frozen to prevent contamination of nearby water supplies. Permanently frozen. Not for 10 years, not for 50. Indefinitely, that cost was not paid by the mining company. It was paid by taxpayers. Modern regulators have drawn lessons from exactly this kind of failure, which is why today's mining companies are required to post financial bonds guaranteeing they can cover closure costs before they begin production. This is money they cannot use for anything else. It is a liability on the balance sheet from day one. None of this means gold mining is a bad business. It means it is a complicated one, where the rewards for getting it right are extraordinary. Consider a mine producing 300,000 ounces of gold per year, with an all-in sustaining cost of $1,200 per ounce. At a gold price of $4,000, this mine generates $2,800 of profit margin on every ounce. Multiply that across 300,000 ounces, and you have $840 million of operating profit in a single year. A mine like that, with a reserve life of 15 to 20 years, is a financial asset worth several billion dollars. It can fund acquisitions, pay down debt, return capital to shareholders, and build the company around it into something much larger. This is exactly what happened with Fosterville in Australia. Kirkland Lake Gold, the company that operated it during its peak years, used the cash flow from a single mine to grow from a mid-sized Canadian producer into a company large enough to merge with Agnico Eagle, one of the premier gold miners in the world. One discovery, developed correctly, managed well, financed prudently. It changed the entire structure of the industry. Now take the same mine, change a few variables, and watch what happens. The gold price falls from $4,000 to $2,000, which is entirely within the range of historical movement. Your all-in sustaining cost rises from $1,200 to $1,600 because diesel prices spiked, labor costs inflated, and you needed to replace a major piece of processing equipment. Your margin drops from $2,800 per ounce to $400 per ounce. On 300,000 ounces, that is $120 million of profit instead of $840 million. Your debt repayments have not changed. Your environmental bond has not changed. Your workforce contract has not changed. You are now running to stand still. Now add one more variable that is completely outside your control. The government of the country where your mine sits decides it wants a larger share of the resource. It raises royalties from 2% of revenue to 8%. At $2,000 gold and 300,000 ounces of annual production, that 6 percentage point increase costs you $36 million per year. Your $120 million of profit is now $84 million, and falling if costs continue to creep. Political risk is not hypothetical in mining. Governments have raised royalties, canceled licenses, imposed export restrictions, and nationalized entire operations with minimal warning. The mine is physically fixed to the ground. You cannot move it when the regulatory environment turns hostile. The gap between a good year and a bad year in gold mining can be $700 million or more on a single asset. The gap between a well-managed mine and a poorly managed one can be the difference between building a billion-dollar company and filing for bankruptcy. What separates the mines that work from the ones that fail is not primarily the amount of gold in the ground. It is the grade of that gold which determines unit economics. It is the jurisdiction where the mine sits, which determines political and regulatory risk. It is the capital structure of the company, which determines how much pressure it can absorb in a down cycle. And it is the quality of the technical work, the drilling, the geological modeling, the engineering, that determines whether the mine you built matches the mine you planned. The richest gold mine is not necessarily the one with the most gold. It is the one that can dig it out of the ground for less money than the market will pay. Everything else, the geology, the machinery, the workforce, the politics, the debt, is just the complicated, expensive, unforgiving process of making that one equation work. And if you can make it work consistently across years or decades of volatile gold prices, rising costs, regulatory uncertainty, and geological surprises, then yes, you might be very rich, but that is not what most people are imagining when they think about owning a gold mine.